Good morning and welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from the final day of the 2018 Options Industry Conference. Joining me is Steve Crutchfield. He is the head of market structure over at Chicago Trading, and we are going to focus on the unique role of market makers in the options industry. Thank you very much for joining us this morning.
Thank you.
And tell us about that, the unique role that market makers have.
Sure, market makers play a larger role in the U.S. options industry maybe than in any other market globally, simply because we have such a wide disparity of products. With all the strikes in terms and expirations, we now have expirations on Wednesdays, on Mondays in some cases, as well as the regular weekly, monthly, and quarterly options expirations. We've got close to 1 million different strikes listed. And when you think about even on a good day, we might be trading 15 million, north of 15 million contracts. The chances that any two investors naturally want to buy and sell the same option at around the same price at around the same time is very, very low. And so the function of market makers in the options market is to warehouse that risk, is to provide those quotes continuously, to hold those positions during the time between one natural buyer and one natural seller arrive in the market.
Well, there's been a lot of reporting about liquidity constraints in listed options. Is this a real phenomenon?
Yeah, it is. We've seen some reporting even just recently. Last week, the Wall Street Journal ran some numbers about this. It's been quite a bit of talk at the conference about options liquidity, and we've seen generally a lot of statistics thrown around, but one that we pay a lot of attention to is the effective spreads over the last 6 years have widened on average by something like 30%. So investors are getting fills in many cases that are worse than they might have otherwise gotten. And that was true even before the recent spike of volatility during a low fall period at the end of last year when you might normally expect markets would be tightening up.
Well, what's driving this and what can be done to fix that?
So there are a couple of things, and the good news is the industry is doing a lot of work, exchanges, OCC, working with market participants to try to address some of these issues. And I do think that we expect to see some progress. One major issue that we're concerned about right now is inadvertent effect of bank capital rules that have been put in place as part of the Basel III agreement subsequent to Dodd-Frank and the financial crisis, have inadvertently effectively penalized bank-affiliated clearing firms, which hold positions for market makers. And so the result is that these option liquidity providers that are very important in the options markets have a more difficult time when they put on larger positions, getting those positions capitalized at banks for reasons that have nothing to do with the actual risk of the position. One example we talk about is a simple put spread, a very low risk hedged options position. In many cases, the capital set aside required at these bank clearing members that hold market maker positions could be 20 times or more larger than the actual maximum loss that the position can incur. Clearly, that's just a inadvertently flawed regulation, and it's something that we as an industry are now working closely with regulators, speaking to the Fed, trying to make sure that they understand the impact that this has ultimately on end users who unfortunately do see worse prices on the screen as a result.
And that was my next question too. Why should investors care?
Yeah, and anything that impacts these market maker clearing firms makes it more difficult for market makers to do business. And unfortunately, this is actually imposing an artificial cap on the ability of market makers to grow their positions, which as market makers, we don't go out and trade just because we want to trade. We're taking the other side of investor orders. So to the extent that we're curtailed from doing that, we have to price that in, and any reduction on the part of market makers to trade ultimately means worse prices for end users.
Another issue for market makers as well is the options liquidity costs that you guys have to carry. Why is that an issue?
Yeah, so really anything that we do that results in us putting a position on means that we have to take a look at what is the cost ultimately to hedge, to manage, to trade out of that position later on. And so there's a little bit of a circular effect that occurs where when some market makers have a more difficult time, the prices on the screens are worse, that makes it more difficult for other market makers to provide liquidity. Some of the steps that we're taking there have to do with working with exchanges, trying to take a look at the vast proliferation of strikes that I mentioned earlier. Mm-hmm. Can we as an industry work together to try to come up with a more coordinated plan such that we're really adding those new strikes, terms, and maturities in cases where investors really want to see those quotes, rather than in some cases perhaps adding a lot of products that may not be adding as much value for investors, but do put liquidity providers at risk because we have regulatory obligations to continuously stream quotes in everything.
All right, well, thank you very much. It was awesome insight.
Thanks for having me.
All right, and thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.